Hey guys, we got a double jumbo for you today. We're going to talk about strategies for financial independence. This is a channel for journeying to the $2 million financial independence milestone. We're at $1.4 million net worth. We're also going to give the 2026 quarter three outlook on the markets. I'm going to do a deep dive and give my whole complete analysis. I'm also going to show you how I'm positioning my portfolio with real funds, with real positions, real dollars. I'm going to go into the exact details of everything that I'm doing right now. So let's dive right in. $1.4 million net worth. And this is something I've been building up over the last 2 decades. I've been investing since 2009. And so this is exactly what I've been doing. I've been consolidating all my funds into one-stop shop, into Fidelity. This is just one account up there in terms of showing you the funds that I'm invested in. I'm a big believer in VTI. I'm a big believer in VU. And I'm a big believer into the large cap growth, as well as the Magnificent Seven, which I've been invested in for a long time, has done really well for me. And so that's how I'm positioning the portfolio. But I also want to show you this in the brokerage accounts, so non-retirement accounts. I am investing every single week in large caps. I'm investing in growth. I'm investing in dividend ETFs like SCHD every single week to build up the portfolio for early retirement. So I'm someone who's in my late 30s and I'm looking to retire in the next 5 to 7 years. So I'm building up that brokerage as a leg to get me to the 59 and a half years where I can pull out of, and the 59 and a half is the sort of retirement year where you can pull from your retirement accounts without a tax penalty. So I'm investing every single week. I also love how things have been moving in the world of AI. It has been a really great run, and I think we're just at the beginning of it. So I'm investing every week in the MUs, AMDs, ASML, AMAT, Intel, Taiwan Semiconductor, Marvel, dollar cost averaging, and the core of my portfolio is built around the S&P 500 and large cap growth and the total market. So every single week I'm buying VU, VTI, VUG, and I'm also building up this brokerage with growth dividend stocks. And so just to give you an example, every single month I'm buying 10, 20, 30 growth dividend stocks every single month. And so I just want to show you those of what I'm doing. Also hedging the portfolio in commodities because of the geopolitical uncertainties, because of the oil prices going up and down. And so that's how I'm hedging the portfolio and getting diversification across international, across all of the whole oyster of the world. And I love the Vanguard Total World, the VXUS. I love the emerging market funds. And so that's what I'm doing every single month, every single week. I'm buying and then positioning the portfolio, as well as adding some precious metals for stability. So love the Magnificent Seven. We've added SpaceX, we've added Bitcoin, and we're buying every single week into these positions as satellite growth companies in the portfolio. Some more examples of the dividend growth companies that we're buying every single month to add to the brokerage account and to build up and drip those dividends and to grow over the long term so that we can achieve financial independence with passive income. One thing I want to go into right here, though, is the 3 phases of investing. There's accumulation, income, and preservation. If you're new to investing or you've been investing for a long time, there's different ways to slice this, but the 3 big categories are accumulation, income, and preservation. Right now, I am in the accumulation phase. So I am big on growth. I want to get the alpha up. Then I want to move the portfolio over to income as I get older and closer to retirement and get the dividend yields up, and then into preservation to protect the wealth over the long term. And so basically right now, since I'm building wealth and accumulation from 20 to 30 or 20 to 40 or even 50, this is how I'm doing it to maximize my income, investing as much as possible and building out the portfolio. And so over the last 50 years, the stock market obviously has done really well, averaging 8 to 10% over the long term. And so that is why I'm a big believer investing in the stock market and the total market ETFs and getting the growth in the ETFs. If you've seen on some of the other videos I put out, since this is a new channel over the last couple of days, you'll see that I've been tilting the portfolio toward AI and to tech and getting the broader diversification as well into the overall market. There's also the phase 2 income phase, which I am not quite into yet, but I'm getting prepared for it. And that's through dividend ETFs and a lot of ways for producing income into the portfolio so you can live off of those dividends, live off of the passive income. And traditionally speaking, you pull from your portfolio at a withdrawal rate of like 3 to 4, even 5%, or you can just pull straight from the dividends and not pull from the underlying value of those accounts and those positions. And then finally, you get to retirement, preserving your wealth, and diversifying, having the income stability, and so on and so forth. One thing that I think that is in terms of a risk that I would say out there, or a little bit of a stumble, is sometimes you can too early in your investing life cycle or journey, I would say not chasing the high yield ETFs, especially the ones that have the decay. I would be careful of that. A lot of there's also reasons to be careful, and this is something just trading and day trading with the cover call strategies and all of that. You just got to really know what you're doing. It can work, but it's just something to watch out for. So accumulation, income preservation. I'm in accumulation phase, headed towards income, and at a $1.5 million net worth, my house paid off, saving, increasing my household income. This is where I'm at, investing heavily in the brokerage. The retirement accounts are about very close to where I don't have to add a ton to them, and they'll be on their way. So I want to talk to you also that assets, the biggest asset often isn't their portfolio, it's their business. So you see a lot of folks out there that they'll be doing like hyping stocks or stock picking, and they'll show their portfolio, or even like dividend portfolios. And I'm not really like trying to poo-poo on them, but you just have to be aware that out there and on YouTube and social media, things like that, those funds that they're generating revenue from, like YouTube ad revenue, sponsorships, affiliate links, and so on. That's the courses. That's what's pumping money into their accounts. It may not be that they're actually picking good stocks or that they're good investors. It could just be that they're taking money revenues that they get from their channel or from social media and pumping it into their account, so it looks like that they're doing really well. But if you actually look at some of their returns, and if you actually look at the companies that they're positioned in and when they bought, when they sold, and so on, it's just, you have to be real careful about, who you can actually trust out there and who you're following. So why dividend investing looks easier than it really is. You can watch someone, they got $8,000 a monthly dividend coming in. They're like, oh, if I just do what they do, if I just buy those companies. But you realize you got to have a huge portfolio to be getting that amount monthly. I mean, I'm talking millions of dollars, unless you're doing like high yield ETF type, 10-15% yields. So it's just something to be aware of that I'm seeing out there. One thing too, since Microsoft has been down, I want to pivot to a couple of different things about, when you look at businesses. Some people don't understand Microsoft. I've been bullish on Microsoft for a long time, and that's because if you can see it, their server products and cloud is 32% of their business, $32.6 billion. And they have a strong moat of various businesses, also Microsoft 365. And some people are like, oh, Microsoft's done, AI, they're way behind. And I believe that Microsoft is going to continue to do well. It pays a decent dividend. It's a growth company, a dividend company. And so I really am bullish on Microsoft, and I think it's a great time to buy it, not financial advice. And it's considering, not just Microsoft, but I mentioned that I'm bullish on the Magnificent Seven. And the reason is, if you look at the returns over the last 10 years, I got an NVIDIA and Tesla in like 2019, didn't buy a ton, but I think I bought 10 shares of Tesla in 2019, 2018, somewhere around there. 10 shares of NVIDIA. Look how well they've done over the last 10 years. Comparatively, the market's also done well. We've had a great bull run, 321% for the S&P 500. And so what's going to happen in the next 10? Well, it remains to be seen. I'm going to get into that in a minute with some of my outlook. Warren Buffett said the most important quality for an investor is temperament, not intellect. You need a temperament that drives no great pleasure from being with the crowd or against the crowd. 100% true. You want to be a contrarian investor, not investing off emotions. And that's why I like to set it and forget it. That's why I like putting things on auto and thinking through what I'm doing, planning ahead. And that's how we're investing. And this is exactly how we're not investing. Some people are like, oh, investing in the stock market, S&P 500, NASDAQ, that's boring. But if you look at it like if the alternative is day trading and just stock picking, that can go very badly, especially when you get margin in there, and start doing options and things like that. You just have to be really careful about that. I chose not to do that. I've made mistakes in the past, and we all learn from our mistakes. But I like how my philosophy of investing works. It really does. And I'm not trying to sell you on my philosophy. I'm just showing you what I'm doing. And so from the S&P 500's perspective, there's something called seasonality in all markets. And so for the S&P 500, coming out of June and July, the market has seasonally, year after year, done really well in July. And you can see on the screen, at the end of June and July, we have a ramp up. The market rallies 2-3% usually on average in every single July. March, you have pullbacks. You usually have pullbacks as well in October, late September, but July has always been bullish. June, not so good, but July. So we'll see if that happens this year. There's a lot of talk out there as well. I like to talk about a macro, and within macro, you've got inflation. So I talk about macro because it's interesting to me. Economics is interesting. I have an MBA, studied global economics for years. I like to look at what the markets are doing, but I also want to see the macro overlay. And to me, it's not just fundamentals of company. I think that you also have to look at the big picture. And one of the things in the big picture, obviously, is inflation, and the Fed is very attuned to inflation. Their goal is 2%. And so where does inflation come from? There's a lot of misconceptions about this. It primarily comes from just the government creating money via just printing money into thin air. That is the definition of inflation. The reason why we're seeing so much inflation out there, whether it's at the grocery store or the gas pump or wherever it is in housing, the prices are going up, and they're going to continue to go up. And that's in large part because in 2021 through 2022, the government printed trillions of dollars out of thin air into the money supply. And that, by definition, is inflation, eroding the value of the dollar and causing everything else to go up in price. So that's exactly what's happening. Again, in terms of the June, this was just another way of showing it. June, July, a lot of us had a bad June in the market, but the good thing is July is coming, and usually July does really well. In terms of tech and sector inflows, there's been a lot of volatility out there, and that's just what we're showing up on the screen. There's been massive amounts of inflow over the last 2 months into tech, and a massive amount of selling off. And so it's sort of like a whipsaw where you see people taking profits. We'll see if that continues in the weeks ahead. But it's also interesting to see a lot of the money appears to be flowing out of gold and Bitcoin and into the semiconductor area. And I've taken a pretty large position in semis more recently. And, it's risky. But I'm taking that position with the understanding that it could go down 50%, and I'm still going to hold it. But over the next 5 to 10 years, I believe it'll go up 100, 200%. Also, in terms of inflation, in terms of wealth, who's holding most of the wealth? Well, it's boomers, people over 70 years old, and the reason is primarily in real estate, and the houses that they've held on to, they've gone up significantly in value because of inflation. Also interesting to note is the cost of household ownership is gone up significantly in terms of just interest, because interest rates go up. It's just logical. When interest rates goes up, it's more expensive to own a house because of the mortgage is higher. But it's not just the interest, it's also the property taxes, it's the insurance, it's the maintenance, it's the repairs. Everything has gone up in housing and home ownership. In terms of assets, I'm not going to go into all the granularity here. What has performed the best in 2026? It's been the U.S. small caps, and it's been commodities, and it's been the NASDAQ 100 has done really well. Emerging markets has done well. This just shows you that you can be diversified across a lot of different asset classes and still do really well. The two haven't done well is gold and Bitcoin have sold off significantly, but everything else has been in the green. The CEO of BlackRock, who knows if you can trust him, but this is a truism. Markets will rise and fall, bubbles come and go, and the only thing that matters is staying invested through the cycle. 100% agree with that. I believe that it's important to stay invested, Sometimes, you can pull back and put a little bit on, keep some on the sidelines for a dip, but usually it's difficult to time the markets because no one really knows what's going to happen in the markets. So staying invested is basically the strategy that I take and agree with that. Now I want to transition to a outlook. I want to give perspective on 2026. And thanks for all the you who've been a part of the channel so far. We're looking to just catalog exactly how I'm investing and how I'm seeing things. So getting to the road to 2 million comes with looking at the market in the future. And so 2026, in terms of the third quarter, what's coming ahead, I look at the market as sort of like an aging bull market. No one knows how long bull markets are going to last, but I'll put it like this. The first half of 2026 reminds us that markets climb a wall of worry despite concerns surrounding tariffs and interest rates and geopolitical tensions and stretched valuations. U.S. equities continue to advance as artificial intelligence spending, resilient corporate earnings, and a healthy labor market support economic growth. And so the third quarter, my outlook is constructive but increasingly selective. I'm still bullish on equities. I believe the bull market we're entering to is the mature phase, and I believe there's going to be greater volatility, sector rotation, and potentially sharp pullbacks as market digests of elevated valuations and slowing economic momentum. And so with that being said, in terms of macro outlook, I believe inflation is moderated significantly from its peak. Unemployment remains historically low. Wage growth is stabilized and consumer spending continues to support economic activity. AI remains the defining investment theme of this decade. Capital expenditures from hyperscale cloud providers continue to reach record levels, creating powerful tailwinds for semiconductor, software infrastructure, electrical equipment, data centers, and digital infrastructure. While economic growth is expected to moderate to the second half of the year, I do not currently view a deep recession as the base case. In terms of equities, the secular bull market remains intact. However, there is concern about real earnings growth, and I believe that quality businesses owning them that have durable competitive advantages, free cash flow, strong balance sheets, those are my preferred investments, and that valuations across technology has become expensive, and there's a probability for a larger correction in the long term, even with healthy fundamentals. Pullback should be expected but not feared, and the long-term investors' volatility, it always creates opportunity. In terms of dividend growth, this is a very efficient way to build lasting wealth, especially if you're in the later phases of growth and entering into the income phase. Dividend growth is not simply dividend yields. It's the compounding. It's the snowball effect. So companies that I like, wide economic moat, strong balance sheets, high returns on invested capital, and consistent drip of reinvesting through disciplined capital allocation. Precious metals is really just a way to preserve wealth, and generally speaking, I believe that owning gold and silver in a small position in the portfolio, I'm adding to that slightly since we've had a pullback, and I continue to believe in a modest application in a diversified portfolio. In terms of Bitcoin, obviously we've had a huge sell-off and continue. I believe there's going to be a lot of volatility, but long term, this is a scarce digital property, and through the halving cycles, I'm bullish over the long term. In terms of real estate, the higher mortgage rates, there's putting a ton of pressure on. We're at all-time highs in terms of housing affordability. It's extremely expensive to afford a house, and that is causing structural problems in the housing market. There are some supply shortages. Overall, there is the beginning of a housing downturn where it's not that there's not a huge supply. The fact that remains is that houses are just too expensive for most people to afford. And so I believe that, the housing market, I'm basically neutral on it. I do believe that there are some locations in select regions where there could be opportunities, but with the higher interest rates, I am neutral to moderately bullish. Commodities, especially with energy commodities, I don't think that oil prices are going to be going back up unless there's a reignition in the war, but I think that they're mostly hit the peak and we're on the way down. In terms of copper, uranium, and these rare earth metals, I am basically bullish on them for the AI infrastructure build out that we're going to see over the next 5 years. And I believe the demand and supply chains are going to cause the prices of these, what I would say as commodity metals, I would say that they're going to do well. Seasonal perspective, obviously I mentioned this earlier, late June through August is always bullish seasonally, but it doesn't always have to happen. In terms of risks, AI spending could slow faster than expected, persistent inflation, and each sort of hawkish Fed positional changes that the market wasn't anticipating and didn't build out. Usually the market looks out 3 to 6 months, but if there is some unusual repositioning by the Fed, I think that's the biggest risk for a significant pullback in equities, especially with higher valuations. Government debt, the government debt is extremely high, but basically what the government is doing is trying to inflate it away. Risks I'm watching is basically geopolitical conflicts, mainly the Fed's policy change, but then overall the slowdown of the economy, and keeping a close eye on AI spending and all things AI. If we see credit market deterioration and weakness in banks, that's also something to watch out for. But overall, these are the major risks. So in summary, overweight quality businesses, overweight dividend growth, heavily overweight semiconductors and AI. Basically, I'm neutral on international just for diversification, slightly buying more metals, Bitcoin as well. And a strategic, I don't have a huge position in Bitcoin. It's about 1% of the overall portfolio. And so neutral on real estate right now. Real estate it's in a bear market. And at the same time, it's unusually historically expensive to buy a house and basically unaffordable. Cash, dry powder, 3 to 6 months emergency fund at least. Want to have cash on the sidelines in a money market or high yield savings account. Final thoughts: new quarters, new headlines, markets rise and fall, predictions can change. Own great blue chip businesses. Keep to the principles, maintain the long-term perspective, ignore the noise. Don't try to time, but instead use time to your advantage to snowball. Stay disciplined, keep compounding, build wealth that lasts for generations. Well, thanks everyone for tuning in today on the video. If you like this content, just let me know in the comments what you think. Drop me a like. If you want to follow us for the long term as we get to our goal for 2 million in financial independence, we're here at 1.4. We're going to keep growing and hit the milestones. Love to have you be a part of the journey with us, and appreciate you all being here. Thanks so much.